We all know that every company is doing business to earn profits, but very few know that profit and cash are two completely different things. And even fewer people understand the difference between cash and free cash. If you are not one of those people, don't worry. Watch this video till the end because we are going to take a deeper look at the differences between profits, cash, and free cash. Let's begin by taking an example of a company that has earned a profit of 100k in a year. Now, this does not necessarily mean that the company has 100k cash in hand. There are two main reasons for this. Firstly, there are certain items in profit calculations that does not have any cash impact, like depreciation. It is only wear and tear of machinery and equipment, which means you are not actually paying cash against this expense. So, if you want to calculate cash, you will have to add back the depreciation expense in your profits. Same goes for all non-cash expenses like amortization, deferred tax, etc. Secondly, whatever the company earns during the year, it does not keep it safe in a bank account or a locker. A company makes money and it invests it in the business to keep the operations running and for growth purposes. For example, you manufacture 100 pair of socks at a cost of 100k and sell them for 120k. Then you use that 120k to manufacture 120 pairs of socks and so on. But if it takes you 1 month to sell all your socks, your cash will be tied up for 1 month. Unless you sell your socks, you will not have cash in hand regardless of the fact that you made profit during the year. And some cash is invested in stocks and some is invested in capital expenditure. Amount invested in capital expenditure does not become part of profit and loss statement, meaning it is not an expense but only shown as an investment in balance sheet. To understand the real movement of cash in a company, we prepare the cash flow statement. Cash flow statement has three segments. Operating activities shows cash generated from operations. Investing activities show details of where the cash is invested, and financing activities show how the company is being financed. So, to arrive at cash, you must add back non-cash transactions in profit, subtract the investments made in working capital, and you arrive at cash from operations. Now, if you have purchased some equipment or invested in capital expenditures, you will subtract it from your cash balance. Then add the money with which the company is being financed and you get net cash balance of the company. The key difference between cash and free cash flow is that in calculation of free cash flows, the cash from financing activities is not considered. That is, you take cash from operations plus cash from investments, add back finance cost, you will get free cash flows of the firm. The idea behind this is to calculate net cash the company generates irrespective of the fact that how the company is being financed. Free cash flows are used to find out the present value of the business. If the company is financed only through equity, then this entire cash is available for use of investors. They can use this amount to reinvest in the company or they can decide to pay dividends to its shareholders. If the company is financed through a mixture of equity and debt, then the cash available after paying that debt is called free cash flows to equity. That's all for today. Thank you for watching.